Okay, thanks everybody for coming out. Today we're going to talk about a product that's both familiar and unfamiliar to everybody. Most people know what the E-mini S&P futures and options are. Today we're going to talk about a newer product, which is the micro options written against the micro futures. And we'll tell you why this might be interesting to you, or at least suggest it. We're not going to tell you anything. You can make your own judgment. My name is Carly Garner, as we've already learned. If you have any questions, comments, concerns, you can reach me at this information. There's my phone number, my email address. If you're looking for more information on trading futures and options, we have quite a few articles and videos on decarlytrading.com, as well as our YouTube channel. We do also have some social media accounts that we post to. We try to do so regularly, charts, commentary, that sort of thing. I do also post pictures of my dog, so if you're not a dog lover, beware. Maybe you can filter those out. I don't know. Maybe there's a setting there. But this is Frankie, and believe it or not, I'm in Las Vegas, Nevada, by the way. We run a little boutique commodity brokerage here in Las Vegas. Ironically, we don't have any clients in Vegas. We might have one or two, but most of our clients are Midwesterners, East Coasters. That's neither here nor there, but we stay in Vegas because the weather's nice and this is in our backyard. I know nobody thinks of Vegas with mountains and trees, but we do have them, believe it or not. That's about 20 minutes from my house. So I write a monthly column for Stocks and Commodities magazine. It's called Futures for You. I also contribute content to Jim Cramer's Mad Money, as well as Bloomberg Television. I do an option segment on Bloomberg about once a week or once every other week with Abigail Doolittle. And I also write a couple of newsletters for our brokerage clients. They're distributed in-house. They include market commentary, research, opinions, and trading ideas. And I've written a handful of books. If you go to Amazon, you'll notice Amazon's the cheapest and most efficient when it comes to buying books. That's no secret. But you will find if you search for Carly Garner, you're going to find several books, like a crazy amount. That's because I've written several, rewritten a few, but trust me, the only three you need to worry about are these. Everything else is either outdated or with a different publisher and we've refreshed it, or so on and so forth. So only focus on these. The covers should look just like that. Ignore everything else. A good hint is if they're trying to charge you like $800 for a book, that's one that's out of print, and just move on. Don't do that. We try to keep our books affordable. Most of the books you saw on the previous screen are $20. And one more thing, if you're interested in following some of our trading ideas and getting information on commodities, we have a mobile app. You can find it in your app store. It's DeCarly Trading. Just search for DeCarly Trading. So let's start talking about option trading or micro option trading. But one more thing before we start, there's a substantial risk of loss in trading futures and options. It's not suitable for everybody. It's not suitable for most people. Most people simply either don't have the financial wherewithal, or if they do, they just don't have the mental wherewithal. And so it's not easy. We're trying to beat the market. And no matter how long you've been doing this, and no matter how good you think you are, there's always rough patches. Trust me. There's no way to get around it. So what we're going to talk about today, though, is the micros, and the whole point of this is to bring complex strategies, or maybe not even complex strategies, but strategies that used to require big accounts and big margin to the smaller trader. And so that's really the key that I hope you walk away from this class with. Speculating is not easy, or actually, I take that back. Speculating is easy. Trading profitably is not. So I talk to a lot of people, and they get really excited about trading, whether it's stocks or commodities or Forex or whatever it is, because they're pretty good at predicting where the price of a certain asset's going to go. And we've all done this before. It's easy to say, when crude was trading at $10, it was easy to say, well, duh, at some point in the future, crude's going to be much higher than $10. But believe it or not, when the market swings in a volatile nature, it scares people. Even people that are right and predicted crude going from 10 to 50 might not have actually made much money on it, because they might have gotten blown out on the lows. They didn't have the margin. They got scared. They didn't pull the trigger. So there's all sorts of things that interfere with actually making money, even though Speculating is actually pretty easy. I think we can all predict where a market's going to go if we don't have our money on the line, correct? It's a lot easier. So it's kind of an illusion, and it eliminates when you're speculating and you're just saying, I think the S&P is going to be down next year. It's really easy to say something like that when you don't have anything at risk. There's no emotion, and you're probably going to be right, but making money off it, that's a different question. So there's a big difference between being right and making money, as we've just discussed. If you're an option buyer, you're going to get killed by time value unless your timing is perfect. If you're an option seller, sometimes you get forced out due to volatility. I'll go back to that crude oil move in 2020. I know of a lot of option sellers, including we had myself and other clients that had some short puts out there that were very, very uncomfortable. And the only people that really survived were those that were trading very small number of contracts in a larger account. But unfortunately, what ends up happening a lot with naked option selling, and I talk about this in my book, is it used to be a strategy that worked actually very well. But in today's markets, maybe it's the algos, maybe it's just Twitter and more information, but there's more volatility. And sometimes that volatility can be really persistent and fast. And so for option sellers that are naked, it can be a really tough game. So anyway, futures traders, on the other hand, tend to get stopped out before the market goes their way. We see this all the time. I'm sure everybody here has experienced that. Or of course, even if you're right, maybe you didn't pull the trigger, maybe you didn't enter the market at all. Let's say you wanted to sell Bitcoin on Friday, but then the market sold off a little and you thought, well, I'll wait till Monday and see if I can sell it back towards the highs. Well, guess what? On Monday, it was too late. Those sorts of things happen all the time. It's easy to look at a chart and say, well, duh, this is what's going to happen. But to actually make money on it is difficult. And the reason why I'm telling you all of this, it's not because I want to discourage you or make you think that you should never trade futures and options ever. I'm just trying to make sure you approach it in a realistic manner. And also, it's a great introduction to the topic of options. When you're trading with options, you're increasing your odds of success because you're giving yourself more room for error. And it's really that simple. It's going to be less stressful, so you're going to make better decisions. It's going to be more comfortable in regards to risk because you can control your risk. With option trading, you can buy or sell a combination of calls and puts and create the exact strategy and risk reward that you want. So options are flexible, they're less volatile. Meaning, and what I mean by volatile is your account balance isn't going to swing as much. Now, it can swing, trust me, I'm not telling you that it's easy peasy, but as opposed to buying outright futures contracts, at least the bigger size futures contracts, trading options is going to be a much tamer experience. Your P&L, your account balance, will be a little smoother than it would be if you were trading futures outright. Now, if you're trading futures outright, you can make or lose a lot of money really quickly, but not everybody's mentally capable of managing the emotions that come with that. And if they're not, then bad decisions are often made. Trading options is a good way to reduce emotions, better your decision making, lower the margin and risk, lower your cash outlay. If you're a spread trader, you can sell options to pay for any option that you're purchasing. Options are priced to lose. So if you're just spending a bunch of money here and there buying options, you're basically buying lottery tickets. Options erode with time. So if you are an option buyer and you find that the market's trading sideways, you weren't necessarily wrong, but you weren't right either. Time value eats away at your option, and it can become very expensive. You can see your big chunk of your account just slowly erode to nothing, and that's obviously counterproductive. So this is a relatively short class, and we have a lot of information to cover. So it's impossible to discuss option trading or option spread trading in any sort of manner that's going to give it justice. What I'd like to just mention is that options are building blocks to an endless number of strategies. There's only two types of options. There's calls and puts. And there's only two actions that can be taken on each of those types of options. You can either buy them or sell them. But you can put combinations of long and short calls and puts together to create just about any strategy you can dream up. And I truly mean that. If you're trading ratio spreads, it could be a 1x2, you're buying a call, selling 2 calls. Maybe you're buying 1 call, selling 4 calls. You could be selling a call and then buying 4 calls. It really is up to your imagination. And that's the great thing about it is, again, you basically customize your profit and loss targets. You customize your your risk basically and your reward. So we already kind of mentioned the option buyers enjoy limited risk. Well, I guess actually I take it back. I guess I didn't mention that. I should have. Option buyers enjoy limited risk. So if you buy a call or you buy a put, in theory, the most you can lose is what you pay for that option. And that is absolutely true unless you hold the expiration and you get exercised and you're just not paying attention. So I need to throw that out there for the compliance department. Basically, if you're buying an option, a call or put, the most you can lose is what you pay for it. And the great thing is you have unlimited profit potential. So this sounds really great. However, the odds of you making money on a long option aren't so great. Your timing has to be really good. In fact, it has to be almost perfect because the option market is not stupid. You're competing with other traders and market makers, and they know what's likely and what's not likely just like you do. They have the same information you do. So the odds of you making money are not great when you're just buying options outright because you have to be more right than everybody else you're trading against, more right than the market. I guess a simple way to put that is options are priced to lose. So if you're buying options outright, you're gaining peace of mind, but you're giving up probabilities of success. Perhaps using spreads are perhaps the best of both worlds. And what I mean by spreads is buying an option, but selling at least one or maybe more to pay for that. We're going to talk about a couple of examples of spreads. There's, as I mentioned before, there's really an unlimited number of spreads that you could potentially trade. But today we're going to pick out two and just kind of give you an idea of what you could do on a risk reward basis using the micros as opposed to the minis, which are much bigger contracts. We already said that if you're an option buyer, you have unlimited profit potential and limited risk, but as an option seller, a naked option seller, you have unlimited risk and limited profit potential. On the surface, this sounds like a bad deal, but in reality, option sellers make more money on more trades than they lose on, whereas option buyers lose on more trades than they make on. So there's a compromise here. If you're selling options, erosion works in your favor. Also, if you're selling options, you can be wrong and still make money. And this is because as time goes on, the value of that option erodes. So an option seller is accepting the risk of a low probability black swan event or an unusual move that can ruin a trading account in exchange for a very high probability trade. Now, neither of these strategies are perfect. In fact, unfortunately, there is no such thing as a perfect strategy, but option buyers have the odds against them. Option sellers have the odds in favor of them. But an option seller that's done so for any period of time knows that it only takes one bad day or one bad week to give up everything you just worked 2 or 3 years building. And trust me, that it can and does happen. Again, I talk about this in my book, Trading Commodity Options with Creativity. Option selling just doesn't work in the long run like it used to. I mean, I really truly believe it did work at one time. At this point in time, though, I do not believe that it does. I'm not saying you shouldn't be a premium collector. I'm saying you should always have some sort of insurance just in case something weird is happening, like what we saw in March of 2020. So a spread trader kind of gets the best of both worlds. Again, nothing's perfect. But if you're buying a call and then selling a call to pay for it, you're combining the advantages and disadvantages. Now, don't make the mistake of assuming that spreads are too complex and they're just too complicated for you to even bother with, because they are in the beginning. I remember when I was first learning options, it took me days just for the concept of a call and a put to sink in. So it seems almost impossible. But trust me, if you do it, if you read about it, you learn it, and then you actually do it, and whether it's paper trading or hopefully live trading with a very, very, very small contract, like something we're going to talk about today, you will start to understand and it'll click, and it'll honestly, this is going to sound impossible, but it's almost easy. It just comes to you. Once you've done it a few times, it comes to you. So don't be turned off. You really owe it to yourself to understand all of the various strategies out there to play different market scenarios and that sort of thing. So a combination of long and short options enables traders to design strategies that net the advantages and disadvantages of buying and selling options. Time value can work in favor of the trade, or at least hedge the premium, depending on how your spread is structured. Long options can be used to mitigate risk. So if you're doing, let's say, a vertical spread, which again, we're not going to be able to get into all the details on every type of spread, but just trust me on this. A vertical spread is buying a call and selling a call above it, or buying a put and selling a put below it. You're getting limited risk and you're also hedging your time value erosion. So it's the best of both worlds. It's not without drawbacks. You're also capping your profit potential, but beggars can't be choosers. So we're going to take it one step further. We talked about why you should trade options, why maybe you should trade spreads, but let's just mention why you should trade options on futures, or at least consider it. Again, it's not for everybody, but if you're going to speculate, and this is not investing, this is speculating, I want to make sure that we're clear on that. If you're going to trade options and you're going to speculate in the markets, the futures are a really great way to do it. So in other words, instead of trading the SPY or the SPX or the Qs, should really take a hard look at the futures markets, especially with these micro contracts, because they have around the clock market access. It's a little complicated on the close, so I'm not going to get into details, but in a nutshell, the futures options trade about 23 hours a day. I'll just leave it at that. So almost around the clock, you can trade options and futures on the stock indices on the futures side of things on the Chicago Mercantile Exchange. And they're liquid. It didn't necessarily used to be that way, but in today's environment, they are liquid. You can trade the minis or the micros, the futures or the mini and micro options, and you can get a fair fill at any time of the day. 2 in the morning, 3 in the morning, doesn't matter. This is important because sometimes things happen while we are not necessarily up and about, right? Also, in a futures account, you get free leverage and margin. You don't have to worry about having a huge account. Stockbroker would want you to have 50 to 100,000 to have leverage and margin. In a futures account, everybody gets it. Everybody's treated equally. Even if you only have a couple $1,000s in the account, you get portfolio margining and leverage. You want to be careful with what you do with it. I'm not saying you should use all the leverage that you're afforded, but you do get it without paying interest or having to have a huge account. This comment's not necessarily focusing on the SPY or the SPX. I'm talking more about crude oil or gold or things like that. But most ETFs are simply funds pooled to buy and sell futures contracts. So if you're trading something like the USO and you think you're trading crude oil, you're not. It's really inefficient. If you want to trade crude oil, do it in the futures market. There hopefully is a micro contract coming soon. They've been talking about it, but it hasn't been released. So we've got our fingers crossed for that. There is a mini crude oil though. In futures, there's no uptick rules. You can buy or sell in any order. There's no day trading pattern rules. There's literally, I don't want to say no rules, but as long as you have the margin to trade any option spread or futures in your account, you're good to go. That's really the only rule. What are the micro E-mini options? First, we'll just introduce the micro futures. I'm assuming most of you know about them, so I'm not going to get into too much detail, but the micro E-mini stock index futures were created by the Chicago Mercantile Exchange Group to overcome the largest obstacle keeping retail traders from futures, and that's risk. The original S&P contract is actually much larger, but we're not even going to mention that today because we're kind of short on time. But there's the E-mini S&P that everybody talks about is $50 a point. With the S&P at about 3,800, it's about $190,000 contract. So anybody buying or selling an E-mini S&P is basically trading $200,000 worth of S&P stock. Obviously, the margin on that's going to be pretty high. It's at the moment it's about 12,000, and the risk is high. When we're seeing the S&P move anywhere from 2 to 3,000, actually in recent history has been, I don't want to say normal, but it's been happening more frequent than we've seen in maybe ever. So with that said, the micro comes in handy because it's 1/10 the size. So instead of making or losing $50 a contract, you're making or losing $5 a contract per point. But it has the same leverage because the margin is equivalent. So instead of a $12,000 margin on the futures contract, we have a $1,200 margin. This gives people more room for error because they're not scared to trade it. You can buy or sell an S&P and hold it for a little while, knowing that you're making or losing $5 a point, not $50 a point. So if you're wrong by 50 to 100 points, which is a lot, you're not going to lose thousands of dollars, you're going to lose hundreds of dollars. And so it does wonders for bringing smaller traders into the mix. There are micro futures on the S&P 500, the NASDAQ, the Dow Jones, and the Russell. However, the options are only written on the S&P and the NASDAQ. Perhaps we'll get some micro options on the other two, but to be honest, even the mini options on the Dow and the Russell aren't that liquid. So I don't think that's coming anytime soon. I don't think there's a need for it. But if you want to trade micro options, the S&P and the NASDAQ are great ways to go because the point value is so small that you can legitimately put together a decent strategy without being required to put a ton of margin down or without losing sleep at night, hopefully. So we already talked about the contract size is much smaller. So if you're trading a mini S&P, you're trading roughly $180,000 worth of stock. If you're trading a micro, you're trading about $18,000 worth of stock, which is a lot more manageable. Now there's still a ton of leverage because the margin on that's $1,200. So for a $1,200 margin, you are making or losing money based on, at the current moment, I mean this changes with the S&P, but roughly $18,000 worth of S&P stock. Okay, so now that we know what micros and minis are, let's talk about using the micro options to hedge risk on futures positions or in an option strategy or even in a covered call or covered put. So before the micro futures, a trader speculated in the S&P on the futures side of things. They were either in the E-mini S&P making or losing $50 a point, or they were out. There really wasn't much in between. They could have used options to hedge their risk, but for small traders, it was really just too much risk, and the hedges were too expensive, and it just didn't make sense. But for smaller accounts, we can suddenly bring these strategies that used to be only for the big guys to really any size account. Even a $2,000 account could do some of the things that we're talking about today. I'm not necessarily saying that's what we should do. You maybe should overfund the account a little so you have some room, but you technically could. So one thing to keep in mind with the micro options is you can use them to control your delta. In theory, you could use them to hedge your mini futures, but you could also use them to hedge your micro futures. So you can get creative. There's really no rules. If you want to be long an E-mini S&P, but you want to protect yourself on, let's say, half the contract, you could buy 5 micro options against it and hedge that way. There literally is no limit to how creative you can get, and you can pinpoint your delta. If you're not familiar with delta, delta is a rate of change in option or position relative to a futures price. So if the delta is 1, your profit and loss moves 1 point for every point the futures market moves. If your delta is 50%, your position moves half for every point the futures moves. Now, just so you know what we're talking about, and if you ever get in a conversation with someone about delta when we're talking about the S&P, when someone says a futures delta of 1, they're always going to be talking about the mini contract. Then if you trade micros against it, you're reducing your delta. So the basis is the mini, not the micro. So this is what I mean by hedging your mini positions. So let's say that you buy one E-mini S&P futures contract at 37.50. The delta on that is 1, right? Because it's a futures. So every point it goes up, you make a point. And by every point it goes down, you lose a point. Now options always are going to have a delta lower than 1. And because we're trading the micros, the option delta is actually going to be 1/10 of the size of what it would be if we were trading mini options. So that we already have to account for that. But you can see how you could customize your risk. You can put a hedge on. This trader might have bought a futures contract and then sold 4 calls against it, 50 points higher, brought in $550, and then sold 6 more calls at 38.50. This is a trader that's long an E-mini S&P and sold a total of 10 micros against it. So if the futures price gets above 38.50, he's basically delta neutral because he's going to be making a point on his futures contract and losing a point on all of his options because he's got a total of 10 of them. Remember, the micro options are 1/10 the size of a mini. So it's confusing, but trust me, if you paper trade it for a minute, you'll get it. So what this trader did is he collected roughly $1,000 in premium. He lowered his delta to 55, which is like half a contract. That premium will pad him a little on the downside. Now, $1,000 in the mini isn't a whole lot. It's 20 points. So it gives him a 20-point cushion. So in other words, if he held all the way to expiration, the calls would expire worthless. And as long as the S&P is above 37.30, he makes something. So it reduces some of his stress and risk, not dramatically, but this is a trader that obviously is not necessarily looking to trade risk-free. He's just trying to taper it a little bit and add some premium collection in there just in case the market trades sideways. He's slowly earning premium collection. If the market explodes higher, that's okay. His profit potential is capped, but it would be quite a nice win because he'd get on roughly half his position. He'd make money from 37.50 to 3800, and then on the other half he would make money from 37.50 to 38.50, and then he would still get to keep the $1,000 he collected in premium. So it's just a way that you can slow things down, and give yourself a chance to make money in two different ways: premium collection and directional trade. Of course, if you're wrong and the market goes the other way, there's obviously still some risk there. Okay, so let's get into more option spreads. Let's see what maybe we could do with an option spread using the micros that you might not have dared do with a mini because of the bigger contract size and the margin. So we're going to talk about ratio spreads. In fact, putting a ratio spread on both sides of the market. It's an open-ended spread, which means there's theoretically unlimited risk, which means many of you may not be comfortable doing this type of a trade using the minis, just simply because if the market makes a massive move one way or the other, you're dead meat. Oh shoot, so I meant to adjust this slide, but I did not. So this should say micro. Yeah, good luck reading that. Okay, so this should all say micro right here. We're talking about micro options. I adjusted the premium, but I didn't adjust the text. I apologize. This is actually a trade that we gave as an idea on Bloomberg last week. And the idea of it is it's a ratio on both sides of the market. Now, if you did this with a mini, not the micro, but the mini, the margin would be roughly $9,000. And although the odds of this trade making money are pretty good and the profit zone is really wide, if for some reason something crazy happened and the market fell outside of the range, somebody with a smaller account trading the minis might really stress them out, and I wouldn't blame them. So doing it with the micro cuts everything by 1/10. You're not going to get rich doing something like this, but the odds of success are favorable. I think you'll agree once we look at the slide. And if it does get out of hand, it's probably not going to ruin your life, hopefully. It would take an unbelievably massive move to do too much damage. So let's get down to it and talk about the details. On the call side, we're buying a March 37.50 call and selling two 38.50 calls. Then on the put side, we're buying a 36.50 put and selling two 3400 puts. And you might wonder what in the heck's going on here. I'll show you a slide soon that has a chart and it'll depict why we might do something like this. But what you need to know is this is a net credit of 20 points or $100 on the micro. If you're trading a mini, it would be $1,000, which is obviously a little more exciting. Even with a $100 premium collection after you pay commissions and fees, it's basically a free trade, right? You're accepting risk below and above the break-even points, which are really distant. When this trade was originally put together, the S&P was somewhere around 3,700 to 3,750. Of course, the market moved pretty quickly from there. The trade makes something between 3950 and 3150, so it's an 800-point range that you can be in the S&P, and this trade makes something, or at least doesn't lose. If it's between 3950 and 3150, you at least get this, but you might get more. You might, if the market lands in a certain price, you might get 1350 or 575, and I'll show you that on a chart. Let's go there. So this is what the chart looks like, and you can see in order for this trade to lose money, the market would have to be down here, and below this you have unlimited risk. So if the market drops below 3150, it could get pretty ugly. Even with a micro, it wouldn't be fun, but it wouldn't be too bad with a micro. I mean, to give you an idea, each 100 points in the S&P is worth $500 to a micro trader. So 100 points in the S&P is a pretty big move. So it would take a really, really massive move to do a whole lot of damage, but it could happen. And above here is the same story. You have unlimited risk above here. But anywhere in between, you make something. This is the dead zone, where you make your $100 that you collected, or if you're trading the mini, it would be $1,000. But on the micro, you make $100 here. Not exciting, but not the end of the world, right? I'm sure we've all had worse trades. This is a ratio spread. So if we're buying the 3650 put, as the market goes down to 3400, the trade is making money intrinsically. In fact, it makes 150 points. Sorry, that's 250 points. I apologize. So you actually make 200 points if the market's exactly at 3,400 at expiration. At that point, you make 250 points on the S&P, which is $1,250, plus you collected $100. So your total profit would be, we'll call it about 1,300 before commissions and fees. If the market's exactly here, on a ratio spread or a butterfly, the odds of the market landing exactly where you want it to are not great. Could happen. It's probably not going to happen. But if the market's anywhere in this zone, you pick up something. I mean, a trade like this, you probably shouldn't set your heart on 1300, but if you can pick up 500, 600, I think that would be a great trade. Plus what you collected initially to get in. I mean, we're talking about a margin of $900 and a very low risk that isn't going to, ruin your day or stress you out too often. On the upside, because the calls aren't as expensive, you can only do a 100-point spread. So on the upside, it's not quite as exciting, but you make money from 37.50 to 38.50. If the option expires exactly at 38.50, you made 100 points or $500. Plus you collected 100 to get in. So you're up 600 bucks before commissions and fees. Again, you're probably not going to get the max profit. That's our goal, but we need to have a very flexible goal when you're doing these types of trades, because the odds of that happening, even if the S&P, let's say the morning of expiration, the S&P is trading at 38.50, trust me, the odds of you or the S&P being exactly at that price 8 hours later at expiration are slim to none. It's just not going to happen. But if it gets close, that's pretty fun, because these are relatively low risk strategies unless something gets really out of hand. It would be pretty uncommon for the S&P to drop this far to get below 31.50. I mean, it could happen. We saw it happen in March, but that sort of thing probably only happens once every several years. So you could also do something like a covered call or a covered put with a lot less stress than you would be able to if you were trading the minis. A covered call or a covered put is the practice of going long or short a futures contract and then selling an option against it. So if you're going long a micro S&P, you could sell a micro option against it, or if you're going short a micro S&P, you could sell a micro put against it. The reason you would do this in the micros as opposed to the mini is lower margin, lower risk, less stress, more lasting power. You don't want to get squeezed out. The key to trading options and commodities is lasting power. So many times I see traders, or I talk to traders that were right. They had a good idea of where the market was going. They were not wrong, but they still lost money because they didn't have lasting power. They either got a margin call or they got scared and they panicked. So it's not as exciting and it's not as lucrative to trade within your means, but that's really in the long run the only way you're going to come out alive. So let's take this example, selling a micro S&P at 3,800 and then selling a 3,800 put for 130 points. So we're selling an option with the same strike price as our futures entry price. Some might wonder why in the heck you would do that. And you would do that because if you hold to expiration, which is in 66 days, if the S&P is at 38 or below, meaning if you were only right by one tick, you keep the entire premium collected. That's 130 points or 650 bucks. Obviously, if you went short the futures market, like let's say you sold a future and you didn't sell a put against it, the only way you'd come out 650 points ahead is if you were profitable by 130 S&P points. So the market would have to be at 36.70 for you to make the same profit as this strategy made with just simply not being wrong. If the market's exactly at the same price you entered the trade at, you get the 650 bucks. The other great thing is if the market goes up, that 130 points you collected gives you a buffer up to 39.30. So the only way for you to lose is if the market's above 39.30. Another way to look at it is it makes something from 39.30 all the way to zero. This is what that would look like on a chart. I don't think I mentioned this, and I should have in the last slide. The risk is unlimited. If we're wrong by over 130 points on this position, there's unlimited risk above. But again, we're trading a micro, so it's unlimited risk on a micro is not nearly as scary as it is on a mini, right? Even if you're substantially wrong, we're probably going to see losses of hundreds, not thousands. So that makes a big difference on your mentality. And also you can see in this chart, the market's obviously never been above 39.30. It's in an uptrend. Nobody can deny that. But the only way for this trade to lose money is if it's above 39.30 at expiration. And the odds are, even if it goes up a little, the odds are it probably will stay below. And anywhere from here down, you make something. If it's at your entry price at expiration, you keep the $650 you collected to get in. So again, the market doesn't actually even have to go down for you to make money on this. It just has to not go up or not go up above this price. The margin on this trade is $1,500, or at least it was when I ran the margin calculator on this. Of course, margin changes. I know that was a lot of information to tackle in a short period of time, so feel free to visit our website, or if you have a question, you can ask us here in the last couple minutes or send us an email. But just to summarize things, for those that are looking to speculate with lower risk, less stress, and better odds of success, the micro futures and options might be a better answer. Small traders can get access to any strategy. They can tailor the risk and reward to any account size or risk tolerance level. They can reduce the odds of margin calls and create lasting power, which again increases the odds of success. So I appreciate everybody coming out. You can find us at decarleytrading.com. That's Decarley spelled D-E-C-A-R-L-E-Y. And if you're looking for more information on our latest book, the latest book is Trading Commodity Options with Creativity. If you visit tradingcommodityoptions.com, there are excerpts, samples, and reviews. And this is what the cover looks like. Do not buy the black book called Trading Commodity Options. I released that in 2009, and we've switched publishers, and we've completely, this is a brand new book, so don't get them confused. Here's my contact information if you have any questions, comments, or concerns.